This week I called it Growth Surprise because that's what we had in the growth figures this week, and I wanted to take a close look at that, of course. But if you've listened before, you'll know that I like to start with a quote, and this week's is, "Ever since I was a child, I've had this instinctive urge for expansion and growth. To me, the function and duty of a quality human being is the sincere and honest development of one's potential." And that's from Bruce Lee, the legendary martial artist and actor. So before I get started properly, the next property business workshop is Tuesday the 1st of April, where the topic is due diligence. An entire day on due diligence, back after popular demand, and expanded on our last DD workshop from 2024, where we also covered 2 other major topics. So there's fresh content and ideas, and we're going to be covering due diligence on business partners and suppliers, due diligence on deals, due diligence on lenders and borrowers, the health of companies and what you can and can't rely on from Companies House, liquidation, administration and receivership, due diligence on deals with limited time or information available, credit ratings and how they really work, financial promotions and the FCA, and a live due diligence exercise on some individuals and companies using some easy to use online tools. Tickets are live and they're already selling at bit.ly/PBW6, and the super early bird tickets have got a genuine 25% discount on face value. And when they're gone, they're gone. They are selling well. I'm also collaborating with a couple of others to deliver a course on finding deals. Now, due to time constraints, we only run a maximum of 2 of these per year, and it may indeed only be 1 for 2025. Alongside Daniel Kennedy and Nick Bond, I will be there. This is Birmingham based, talking through, no holds barred, the methods we use on a daily basis to find a healthy stream of property deals. Whether you're looking to buy them for yourself, become a property trader, or earn an extra income stream through sourcing for others. We run these because, as per any of the training I get involved in, we're actually doing it with 90% plus of our time, and talking about it with 10% of our time. That's the right ratio, in my view, to get real world and up-to-date information. It's great value, very intensive over the 3 days, and as always, packed with content. First 9 tickets are sold, so we only have 11 more. We've got a limit of 20 so that we can get into the right level of depth and detail with everyone attending. This one will sell out, folks, because 20 is our limit. So there's more details at propertymatchmaker.uk/sourcing-solved, or you can go to bit.ly/sourcing-solved 2025. So welcome to the supplement proper anyway. If you're watching this live, I'd really appreciate a like, a comment, a subscribe to the channel. It helps out an awful lot. Thank you. It's a juicy week for news this week, but did you find space in your heart for Rachel or Kia this week? Some further good news around growth and bond yields generally, but we ended the working week with more tariff threats that most actors in the marketplace are actually largely ignoring. So I just wanted to kick off with a couple of points around tariffs. Firstly, there's already loads of them in play, tariffs, right, all over the place, all over the world. We're about level with the US, although they've raised a VAT issue where they've noticed we get our sales tax on their goods when they sell them in our country. Now, of course, they get their sales tax on our goods, but not at 20% generally, and that tends to be levied at the state level in the US. It doesn't seem like a big deal to me, but it is a bit of an excuse to try and get us to do something on this front. And you can see how Donald Trump likes to negotiate. It's pretty transparent. It's there for everybody to see. Starts big, then sees what happens, really. Starts from a position of taking Greenland or Gaza or mention wherever you want, and then sort of rose back from there in order to force action in areas where he wants to see action. Let's just see how it plays out, because it's mostly a distraction, to be honest, rather than anything to be too concerned about. When would I get concerned? If they started to look at tariffs on services rather than on goods. Why? Well, because UK economy is 80% service industry driven. So whilst we don't want to just fritter away the waning export industry that we have, also it's not a huge deal that's going to impact everybody at an individual level in the United Kingdom. Now, this week's deep dive sees me recant my stories for the week from the Bank of England regional briefing, where the long-suffering but wonderful regional rep for the West Midlands puts up with my continual questioning. This week I asked about unemployment and I got an interesting answer. On reflection, I should have asked a different question, so I do ask it and then I try and answer it myself. And in the real-time slot, we have from Chris Watkin and the Property Market Stats Show, bombing on through February. We get to ask that question we always want to know the answer to: what is currently happening in the UK property market? So this is the report on week 5 of 2025, because we lag 1 week behind with these. And we're starting to see the listings data normalise a little. We did have a huge amount of listings compared to historically, but it does also depend on which day of the year is the first day for listings, as far as first proper business day of the year, if you like. But 2025 is still the biggest start to the year for listings since 2016, if not before, because Chris's data only goes back to 2017. It's now 11% higher than we were last year, and in 2024 was the highest year for listings apart from every other year since 2016. So we're 23% ahead of the pre-pandemic average. 12% of the stock was reduced in week 5 compared to 2024's average. A market of more stock, just as this one looks like, of 11.9%. Although the 5-year average is 10.6% for reductions. So what are we seeing? We're seeing more homes come to market, and we're seeing more reductions, both in absolute numbers and in percentage numbers, because it's taking more to stand out on this market. So the gross sales still sit between 2021 and 2022's number. Now, gross sales were very high in 2021 because we still had that backup, that lag from when the market was closed. And also you had so many people highly motivated to move, thinking they were working from home forever, thinking all these things that were changing because of COVID. We had 27,000 homes sold subject to contract in week 5, which is 33% higher than the pre-pandemic levels. 23.7% fell through, which is still below the 7-year average of 24.2%, or about 1 in 4. Net sales are similarly outsized. We had 20,600 net sales, so that's gross sales minus fall-throughs, and that's 26% higher than the pre-pandemic 3-year average. Now look, I always like to give Chris a weekly shout out because he's more prolific than just this epic tome he releases weekly on the UK property market. He comes up with some great stats on a regular basis. Drop him a like, a subscribe and all the rest of it, and some kind words for his content creation. If you're in the industry and want a ghostwriter, that's his core business, so give him a shout. The article's always published on the Property Industry Eye website, and the video is on his YouTube channel, which is at Christopher Watkin. So we slide from the real-time UK property market to the macro segment like a graceful figure skater. The RICS house price balance and the GDP growth rate are 2 guarantees for the supplement. And then there's a rare gap this week. So I wanted to fill that gap with an analysis of public sector productivity, which was reported on this week by the ONS. And then you know we are completed by the gilt and swaps market overview, of course. So RICS and the UK residential market survey. A bit more levelling off now before the stamp duty cliff is gone, I think. Anecdotally, I'm still hearing stories of people agreeing deals this week, and I don't mean professionals, I mean retail buyers on the open market, the main market that exists in the UK, and thinking that they're going to complete before the 31st of March. Now that's extremely hopeful if using a mortgage lender, possible if in very short chains, of course, if well organised with excellent solicitors, and if there's no leasehold involved, I would say. But please remember, there is going to be a conveyancing bottleneck here. So you need to be the squeaky gate that gets the oil if you're purchasing over £125,000 and you want to beat the deadline. RICS lead with buyer demand broadly flat in January, but sales volumes are still expected to rise gently over the months ahead. So sales market activity levelling off, house prices rising steadily at the national level, and further pickup reported in new instructions to sell. Largely, and that's why we look at them so closely, very much what we've seen in the Chris Watkin figures week to week, as you would expect. So the details, the number of new buyers registering is flat month on month. That's the implication of the headline. Sales agreed plus 3% on the month on the index, so that's slow growth. Sales expectations near term are plus 10%, which I'm not sure about personally. Near term means the next 3 months. We're now at a pretty high place historically, with a stamp duty change for the worst coming. So I would disagree with the surveyors who've been surveyed here. Plus 30% see an increase in sales activity for the year, but we can't forget that 2024 started relatively slowly, so it's still possible. But textbook economics suggests that higher stamp duty on both investors over 40k, since October, of course, and then from April the 1st, everyone other than first-time buyers on houses over 125k, which is 90% of the stock in the UK, and first-time buyers above 300k rather than 425k slows down the transaction numbers. So I'm reserving judgment. I see more people staying put, just as we're already seeing in the rental markets. New listings still raw forward though, plus 25% being the number for January 2025. Again in line with Chris's weekly efforts. The average agent has got 45 houses in the shop window at the moment, and that number was 41 in July last year. Appraisals for new stock to take on are also well up by a similar number. The 3-month outlook for prices has flattened a fair bit from plus 14% to plus 3%. Remember, this is only the number of surveyors answering the survey in a positive or negative way. They're not predicting that sales prices will go up by 14% or 3%. That's not what it means. But I'm not particularly surprised here. This would be more in line with what I'd expect from the stamp duty changes. First half of this year, bit of a bump upwards, bit of a slope downwards. Can't read too much into it because there's been a stamp duty change. But tenant demand has also slipped from plus 18%, which is a fast increase, to plus 2%, which is nearly flat. But new landlord instructions are still down, however, at minus 19%, meaning more imbalance. Plus 23% expect near-term rental increases, which is down from plus 32%, which makes sense given the levelling off in demand. But the big ones for the survey are the plus 22% citing price increases during January, below the last print, which was plus 26, but still a clear positive reading. Plus 52% see price rises over the next 12 months, compared to plus 53% last month, so no real difference. Plus 52% would be 24 saying down, 76 saying up of every 100 respondents to the survey. So positive but slowing demand as we approach that stamp cliff. The tenant demand is, however, an interesting start to the year. January is normally heavy for demand, but there was no major pickup from December. Certainly something to watch, and the market is perhaps behaving according to affordability. Ultimately, people cannot go into properties they cannot afford, although we still see plenty trying to do so. Certainly not as much as they could once when referencing checks were less stringent. On to GDP growth then, because we had a few headlines this week, all the way from the Telegraph trying to pretend that nothing had happened, through to the Guardian gleefully proclaiming Rachel Reeves as the Messiah. Neither were true, of course, but the goalposts are in the place that they are for a reason. But it was a major upside surprise. Great news for the economy. Sad that we're squabbling around a 0% number for the quarter, something that's been happening for the last 2 or 3 years in this economy, but 0.1% up is better than 0.1% down. Not for the gilt yields, of course, who had priced in the economic consensus of a drop of 0.1% in growth, thinking that this would continue to support the cutting cycle in interest rates. The starkest shock was the 1.4% print for the 12-month period, as opposed to the expected 1.1% print, because the expectation for December was 0.1% growth, and instead it was 0.4%. December 23 was a very weak month, and this base effect had been mentioned by some in the run-up to these figures. The ONS report offers us further illumination. Services were 0.2% up on the quarter, saving the day as usual. Construction was up 0.5%, but production was down 0.8%. Real GDP per head was down 0.1 in Q4, and it was down 0.1 across 2024 in general, whereas the across 2024 real GDP increase was 0.9%. So that just shows you how much difference that December 2023 number made. That would suggest a population increase of around about 1% for the whole of 2024, or around 680 to 690,000 more people in the UK. It's no secret that the ONS figures don't always add up like this, though, of course. Real GDP per head over the 2024, from the quarter 4 2023 to quarter 4 2024 period, is up 0.4%. And this didn't make the headlines. Now remember, that started from technical recession territory, but it is an improvement. The last 20 years or so, or post-financial crisis, we've seen GDP per head going up at about 0.7% per year. So still about half of what people might be used to, although what they're used to since 2020 has changed immeasurably, of course. More likely it feels relatively good compared to the more recent past, but the good old days feel a long way away. If you break down the per cap measure to quarters, it went 0.6 in Q1, very, very good figure, 0.2 in Q2, minus 0.3 in Q3, and minus 0.1 in Q4. I'll refrain from any obvious political statements here. These figures also included a revision upwards in Q1 2024's GDP. Technically the last government's win, but it appears to be this government's win, which proves, as always, that it's better to be lucky than good. Now the interesting pieces of meat out of the ONS report then. Nominal GDP up 1.1% in Q4 2024, mainly driven by an increase in the compensation of employees. Services are up 1.7% in real terms from a year ago. They carry the economy as always, as the other sectors have lagged this. Production's down 1.7% and construction was 0.9% up. Households kept it tight in Q4 2024. They increased spending 0.6% in July to September, but there was no real increase at all after that for the Christmas period or Black Friday. Household consumption was up 0.7% across 2024. As we know, savings rates also increased as the surplus was not all consumed when it came to higher wages, benefits, etc., which all exceeded inflation in 2024. Real government spending was up 2.1% on the year. Real GDP per capita, as far as the G7 goes, we were joint bottom with Germany in 2023 and look guaranteed to be 5th out of 7 in 2024 when the other countries get their data published. We'll be ahead of Germany, we'll be ahead of Canada, and we'll be behind the rest. Now the USA grew their GDP per capita by at least 0.4% per quarter, apart from in Q1 2024, when it grew 0.2%. Now that's for every quarter in 2023 and 2024. They're showing a greater per capita growth rate than our real GDP growth rate, and that's our most hopeful projections. So really are a bit of a mess compared to what the US is achieving. So the tale of the tape is one of flat growth, struggle, and an economy absorbing a shock on the private sector front, the employer's national insurance contribution rise. Public sector productivity then, much talked about. Nearly all the growth at the moment is coming from a growth in government spending, 2.1% up on the year last year. Not what a capitalist-led society would expect, frankly, although you do have to question whether the UK at this time is a capitalist-led society, of course. So what's the lowdown? Well, the report released this week by the ONS only covers July to September 2024, Labour's first quarter in power. This is the first attempt at quarterly estimates of healthcare inputs, outputs and productivity, and these are statistics in development which come with the usual caveats. But you can understand why we want to look at healthcare first above all else. It's the biggest area of interest of the individual components of the economy, almost always as far as public opinion goes. It's also by far the largest individual service area by share of expenditure and rising. So, the headlines here: total public service productivity down 1.4% year on year, and healthcare productivity 2.4% down year on year. More growth in input than growth in output, basically. Quarter on quarter, however, it did grow, compared to a fall in Q2, both across the board and for healthcare, both by 0.2%. So perhaps there is light at the end of the tunnel, although Q2 would have seen a big cost increase absorbed, of course, so perhaps we should expect the same in Q2 2025. The really damning numbers that desperately need reversing, and these are huge. Total public service productivity in Q3 24 was estimated at 8.4% below the pre-COVID peak in Q4 2019, and healthcare productivity is 18.5% below that same date. 18.5%. You can have a lot to say about it. Permanently broken health service thanks to the pandemic, lack of drive of value for money with the pandemic recovery programme, huge waiting lists leading to productivity issues, demotivation, large cost increases after years of the sector taking austerity right in the face. On the upside, plenty to shoot at in terms of improvement, and this should be able to happen. On the downside, what a drain on the public purse while it gets sorted out, if it does. And this could easily take a decade. I shared a graph this week with the printed version of the supplement, which shows we basically lost all the productivity improvements from 1997 when the pandemic came, and now we're struggling. We're actually going the wrong way with productivity since the official end of the pandemic. So a really massive, but a 1 in 100 year event has destroyed 25 years of productivity improvements, which is a real shame, and it's going to, of course, take multiple years to fix. I mean, serious task ahead of the Labour government and probably the next government as well. So how else could we frame this in plain English? Well, in healthcare, as in the wider economy, When COVID came, the taps went on. There was widespread theft and fraud and waste. I'm not just talking about grant claims that were opportunistic or bounce back loans on dormant companies or sneaky furlough, but in terms of money allocated and totally wasted, track and trace would be the single largest example. The public sector has ballooned, and like any organisation growing at 10 times the previous growth rate, or indeed that was used to being shrunk after austerity, a serious amount of inefficiency has crept in. Starmer has at points promised ruthless cuts, and in honesty there will be no solution to these productivity problems until that solution is actually implemented, whether that's by Starmer, whoever succeeds him, or by another party the next time the government is changed. So it's an interesting puzzle to say the least. Now, to bring up the rear guard, the gilts and swaps. It won't be a surprise to regular readers and listeners to know this would have been an up week for the yields, having already heard about the growth figures overshooting expectations considerably. Now, the logic here is, if the economy's doing okay, and okay is about the best we can say at the moment, let's face it, then there's far less need to cut the interest rate. This logic is a bit bendy, in my view, around where the natural rate of interest is, but it does hold some water, and more importantly, it does impact the markets. We opened the week at 4.182% yield on the 5-year gilt and closed it at 4.223. Now, I never like ceding ground, but 4 basis points we can live with on the back of the week that we've had. The first big move was US inflation coming out hotter than expected. They've had no core inflation below 3% for over 3 years, as was pointed out this week, an argument I've been making for many, many months on UK inflation. And the US bonds still impact the UK gilt yields and prices significantly. The second one was the growth figures being released. As so often, it's what the market didn't do rather than what it did. The yields tested 4.12% on Monday, so we're up 10 basis points since then, but only 10 basis points. That's in spite of a really significant upside miss on the growth predictions. The longer term view is looking a lot more guilty at this point though. Slow movements, lower volatility. Or perhaps the bond vigilantes are still licking their wounds from January's efforts to squeeze yields well above sensible levels. The 30-year gilt at 5.1% yield still looks great value to me, as an aside, and I've been buying some. The swaps then, the 5-year gilt closed Thursday at 4.207% and the swap at 3.893%. That's almost exactly what it was 12 months ago, 0.1 basis points away, unbelievably. So still pretty positive for mortgage rates, and we saw more cuts this week as the new pricing looks relatively stable. 5.9% debt, that's 5-year fixed limited company, 8.35% yield, that's still my barometer for worthwhile vanilla buy-to-let. So if you're going to have an up week on the yields, it was definitely a palatable one. In weeks like this, it's what the market doesn't do that tells you more than what the market does do. The fact that the market stayed so calm in such a growth upgrade forecast is a good thing. Let's not navel gaze for too long over 0.1% growth though in a quarter. There's a significant problem coming in Q2 of 2025, simply because inflation will be back to pretty darned high, over 3.5%, likely over 3%, likely over 3.5%. And remember, GDP is declared after inflation. So if we had the same nominal rate of growth, but inflation has nearly doubled or doubled from September, we're going to see a dramatic impact on the GDP, the real GDP figures. So there won't be a sudden flurry of economic activity. There will be a bit at the lower end of the income spectrum thanks to minimum wage changes, but not enough to compensate for rising energy bills and the likes. From 2 weeks ago, when the best guess for the April price cap was a 1% increase, it's now looking like a 7% increase. So good job the heating can go off in April, right? Into the deep dive then. When we have the quarterly bank meeting that is accompanied by a full monetary policy report, as the meeting on the 6th of February was, there's always a roadshow by the regional reps to disseminate and break down the changes that come from the meeting and the changes in their outlook. I made some points around these last week, but the insight that the regional rep provides to the room and his continued patience of a saint with my questions, aside from anything else, mean that we will go again on the bank's report and change in views, but from a different angle. So last week I really wanted to try and answer the question, should we be looking at different angles to base rate now? Are we finally getting into a cycle that will cut a little faster? Have I got it wrong by saying there'll only be 2 cuts likely this year? The answer was maybe a little, but if it is, it's 3 cuts instead of 2. I reiterate, I'd love to be wrong about this. Goldman Sachs suggesting 6 cuts, JP Morgan suggesting 5. Bring it on, folks. Firstly, they do have to talk as they want others to act. That's just the game. And secondly, they may be trying to use their considerable influence to get policymakers to sit up and listen. That's unlikely to work, but you can't blame them for trying. They're better off in a world of cheaper debt. They should be more careful though. Cuts like that, if unjustified, and they would look unjustified, especially going below 3.5%, 3.75% at this time, would actually send bond prices down and yields up, because the feeling would be that the central bank wasn't in control and wasn't looking after the long-term interests of the economy, first and foremost. So, to the report and the rep's commentary, but first my question. I asked this week about unemployment. My issue comes from the fact that the bank is notoriously bad at predicting unemployment. I've taken them to task about this over the recent years in the supplement, and I've been a much more accurate predictor of unemployment than they have been. This wouldn't surprise them because they even recognise themselves that their unemployment forecast is wrong, and it's wronger than most of their other forecasting tools. Now there's a further problem here. The ONS keep mentioning how bad they know their own unemployment reporting is at the moment since COVID. We're continually promised fixes of this, but the date for a fix keeps being pushed back and back, and there's no guarantee it will even be this year. I reported a couple of weeks ago on the Resolution Foundation report from November, which suggested that nearly 1,930,000, in fact, more people were in work than the ONS was suggesting. That would, of course, put unemployment down. Although it depends where they're sitting at the moment in the figures, because if they're sitting in the economically inactive, it wouldn't put unemployment down a lot, but that's a technical point. But there's further problems. What does in work mean? Well, it means they've got a job. Doesn't mean it's full-time by any stretch. A typical middle-class family, it strikes me these days in the UK, has one in full-time work and one in part-time work. The ONS's best stab at this comes in the Working and Workless Households in the UK publication, which they bring out quarterly. The most recent quarter they refer to is the third quarter of 2024. Of the estimated 21.4 million households where at least one member is aged 16 to 64 years old in the UK, 59.3% had all household members aged 16 years and over in employment during July to September 2024. There are an estimated 26.8% of households with a mix of at least one working and one workless adult, and an estimated 13.9% of households where no member of the household was in employment. They don't highlight the average full-time equivalents across one of these households, and there are a number of reasons why there might be data in that sample there shouldn't be, and data omitted that should be in, and we haven't even got onto hours of work there at all. So we have to accept this is a stab at best, but the bank typically doesn't even get the direction of the trend correct, although I think they have at the moment. They think unemployment is going up, and this is definitely happening, and the PMIs and real-time surveys suggest that's not reversing particularly quickly. Let alone do they get the amplitude of the wave correct. So it's here where I think at the moment they're making a mistake. My question was, if the bank's model is wrong here about unemployment, and instead of the 4.5% they think unemployment is going to top out at this year, we get closer to 5%, I'm at 4.8% plus in my forecast. Would that mean a cut in rates faster than currently being forecast? So the logic there would be the economy's not doing very well. That's manifested by unemployment going upwards, and that means we could cut rates a little more closely to the natural rate a little more quickly. Now the rep always gives an excellent answer, and this quarter was no different. It depends why we are wrong, he said, and by how far. Now this makes perfect sense, of course. Are they wrong because they didn't accurately model the economic shock impact of the employer's national insurance rise? This is perfectly possible, of course, because there are limited shocks of this size to compare to historically, and so any models developed on the back of it will be based on estimation to some extent. How serious is it? Well, last week I mentioned it was 7% of next profits from the year, but suggested it would be closer to 50% of profits for some small businesses. If you rely mostly on staff, hospitality, leisure, retail, it will hit you harder. Next can cut more people with staffless checkouts in large stores, and toothless security with AI measures filtering through the pipeline, no doubt. So if it is a one-off, which you can and should categorise Rachel Reeves' employer's national insurance contribution efforts as, and people would change their mind on that if she raises tax again next month, of course, but I'm sure she isn't that silly. Then a one-off sets a new equilibrium rate of unemployment, which the bank sees as around 4.75%. Is that correct? I'm not so sure. The incessant drive of the minimum wage upwards seems to me hell-bent on making unemployment more numerous, and I'm not convinced that it isn't deliberate either. I'm also not convinced that it is a bad or economically harmful idea, interestingly enough, because it forces employers to take action on productivity and invest in technology, driving economic activity. The Nexts of the world and the Sainsbury's and Morrisons, as I mentioned last week, get to use this covering fire as a reason to go more and more people-less in their stores. Just like a bank, desperate for any excuse these days to close a branch, employers' national insurance rises mean that plans for closures can be brought forward and be less difficult to explain to customers and less damaging for brand reputation. While everyone's at it, it's all very safe. I'd personally be surprised if we don't see unemployment rise above 5% in this Parliament. In fact, I'd be really surprised. There's never been a Labour administration which saw unemployment go down. You could make arguments either side as to why this is the case. Now, they came in at 4.2, that was the June 2024 figure. So there's headroom between there and 5%, but the current 4.4 was the ceiling from mid-2017 onwards, if we ignore the pandemic blip, which still only saw a pandemic high of 5.3% in December 2020, but of course that was thanks to furlough. The last time we saw 4.4 or below before that was mid-1975. Yes, really. On measures of productivity, this can force productivity upwards. The same output with less input, fewer people, productivity goes up. Growth results. The losers in this process need to retrain and get back in with new skills, or move or pursue another option, such as self-employment, notoriously overworked and underpaid, as shown by the official figures, not just coming from the mouth of a self-employed person. So, my 5% versus the bank's 4.5%, is that a big deal? Well, 5% is 11.1% more than 4.5%, and it would be a change of 6 times magnitude compared to the current rate. That sounds pretty big. Would it worry policymakers, though, and rate setters? I mentioned the golden 6% in my long-form version of the question this week, once heralded by the Bank of England in the early 2010s as the number to go below. Mark Carney even mentioned it and said we could consider raising rates once unemployment got below 6%. And I was fishing around just how much the bank consider unemployment to be part of their broader economic stability remit. The answer really is it wouldn't change too much. Perhaps the timing of a cut at the margin, perhaps, but probably not. It isn't a big concern at the moment. It's perhaps a bit of fuss about nothing. The extra 150,000 people or so that would be unemployed, if I'm right, and the bank is wrong, might disagree with that, of course. The other interesting parts that came out of the meeting and the breakdown of the report that I wanted to share with you are as follows. Let me be clear, there's been a big shift since November in the bank's near-term expectations. I referred to this last week, but it irks me quite a bit. It was obvious that the budget was very anti-private sector and anti-business. Business picks up the tab for governmental failings, of both colours, frankly. And then, as a second-order consequence, that hurts consumers and everyone, whilst hurting business owners and shareholders as a first-order consequence. Anyone disputing that is an idiot. It isn't an opinion. It's just a statement of economic reality. So why have so many changes been needed in forecasts since November, which I'll remind you was after the budget? Anyway, let's deal with those changes and their magnitude in order of importance. Firstly, inflation expectations. I focused last week on the fact that the 2025 Q1 prediction, and like Bon Jovi would say, we're halfway there, had been adjusted from 2.4 to 2.8, and that was a big deal. But I'd missed the fact that the Q3 2025 prediction had been moved up even further to a massive 3.7%. So that's across the Rubicon, really. Sub 3.5% looks and feels fairly safe. And I've discussed many times that the reality is 3% inflation is the new number in the UK and the US, for some different and some similar reasons, but that 4% feels uncomfortable and 5% is really problematic. The big beneficiaries, never forget, are the UK government themselves. Luckily, fairly closely followed by leveraged property investors. So don't read about this and be unhappy. Be happy, but don't expect rate cuts if the bank's expectations do play out in the near term, or if reality actually overshoots these new numbers. This 3.7% is being judged as transitory. They haven't used the word, but they've said as much. and with their track record, that isn't pleasing. However, in spite of my constant protests about this not feeling like a 2% inflation environment, nor does it feel like a 4% inflation environment. Remember, shocks can change things and can go either way, but geopolitical risk feels a little lower at this time than it has done since early 2022. I'd suggest, depending on how you feel about where on earth the negotiated settlement, presuming there is one, between Ukraine and Russia is going to go. The US isn't going to get its way with Europe rolling over here, which was always going to be the case. So, as so often, it's in the court of the orange man to perhaps soften his position somewhere, or give and take a bit more from his old mate Mr. Putin. That Q3 number could be costly low to the Treasury, 3.7%, and thus to all of us. I've said a few times, don't underestimate how lucky this new government was to achieve 1.7% CPI in September 24, because that's what sets the tone for 2025's index-linked increases. 2025 could be a reverse, with September being peak CPI, and that could suck a little more light into that aforementioned black hole, needing more and more money to service it. Perhaps cautionary, but worse than all of this is in the past couple of weeks since the report has been released, energy prices have gotten far worse as price caps and the likes go, as I've already mentioned. So these forecasts, if they were rerun today, might show 3.8% or even 4% for Q3. I'm aware personally that the downwards price effects on energy coming back from insane pricing post-COVID are over. And also some of the fact that those base effects that dragged CPI down to the 1.7% in September 24 will become base effects that are artificially low when we get to September 2025. But I'm not in tune enough to attempt to forecast inflation month to month. The juice isn't worth the squeeze for me. However, I did predict 3.1% for the year, and if anything right now, reading all this, it feels like it might be a downside miss. But I don't feel a need today to change it. When January's print was 2.5, I think it will be quite close. If the unemployment trend continues, rather than adjusting to the price shock post-April, then it will be a different matter, you'd think, because that will force even higher savings rates as well, if people really do start to believe, outside of the more enthusiastic arms of the right-wing mainstream media, that a recession really could be on the cards. This would send consumption down and therefore contract GDP, potentially. That would be a worst-case scenario rather than a base case, based on what's currently happening and has happened. Okay, I know that'll be a bit heavy for many, but I really wanted to clear that up for those who are really into the more technical details of just why things work as they do, and why I might or might not be moving too many of the predictions I've made for 2025. To finish, I just wanted to highlight some other changes that have been made to bank forecasts since November's Monetary Policy Committee report. Housing investment, this is a catch-all figure including new dwellings, improvements and spending on services that are associated with the sale and purchase of property. And this looked like minus 7.25% in 2023 and 0 in 2024. The new forecast is 0.5% for 2025, which is down from 3.5% in November's forecast. That's quite stark, and it's also not very helpful for Labour's pie-in-the-sky 1.5 million homes target either. There was never any chance, but now the miss is going to be in the many hundreds of thousands. On the flip side, business investment forecasts have picked up. As I said earlier on, it might be the investment of necessity to deal with continual staff cost pressures. But either way, the bank saw 2024 end at 3% rather than their forecasted 1.5%, and they've only trimmed 0.25% off their 2025 forecast on the back of that. Overall, that's a win, and we need to take the wins here where we can. Exports have deteriorated really significantly since the November 2024 forecast. The 2025 forecast number now looks like minus 0.75% rather than plus 2.25%, which is where we were in November. Now, tariffs and uncertainty are making those numbers very hard to predict, of course. Productivity is perhaps the most depressing one of all. The bank now forecasts a 0.5% drop in productivity in 2025, when they have forecasted a 0.5% increase, which is still below the trend post-financial crash. This will not help foster any sustainable growth at all in 2026 and beyond, if this is correct. Their annual number for inflation now to the nearest 0.25% is 3.5%. It was 2.75%. That's for 2025. They've also forecasted lower household savings rates, although still historically high, at 9.25% rather than 10.25%, which is where they were at. As above, if unemployment does turn from a shock trend to a more permanent embedded pattern, this could easily go the wrong way. So cheery all round, I know, but let me remind you that this borderline stagflationary environment will mean no bad thing for property prices and rents. And whilst wage settlements hold up above inflation, which is still the expectation for this year, and whilst disposals continue, which is still my expectation for this year in the wider market, nominal debt keeps on depreciating, and prices, once the first half of the year is out the way, with the false prints that the stamp duty reintroduction will leave on the housing market, should tick along nicely alongside everything else. So as I draw to a close once more, I'll just take the opportunity once again to remind you of the sourcing course I'm going to be delivering on the 21st to the 23rd of March alongside Dan Kennedy and Nick Bond. All sausage, very little sizzle, real-time examples of how we find deals on a daily and weekly basis, an experience of many tens of thousands of deals analysed to lead to over 1,000 deals being done between us all. There's a reason why we call it Sourcing Solved, because that's what we're aiming to do. And there's more information and tickets at bit.ly/Sourcing Solved 2025. Remember, book your tickets as well for the 1st of April for the next property business workshop. Due diligence, the most comprehensive day on DD that will ever have been delivered in the property space. I can guarantee it. Join those who've booked their super early bird tickets at bit.ly/PBW6, and that's a number 6. So, above all, especially after as detailed a deep dive as that, please remember to keep calm, always listen to the supplement, and carry on. There's going to be opportunities abound this year. Of that, I've got no doubt. Thank you.